I'm Matt Bishar with REIT.com, and I'm here in San Diego for REIT World 2012. Joining me for this episode of CEO Spotlight is Steve Grimes, the President and CEO of Retail Properties of America. Steve, welcome.
Thank you very much for having me.
How would you sum up the company's experience since its IPO this year?
The IPO has been really good. We accomplished, for the most part, all of our objectives. You might recall we were a public company. We've always been a public company, but the IPO was just kind of the next stage in our evolution. And with that, we set out to do a couple of things with the IPO, that being deleveraging, and we wanted to do that on a number of fronts. Through the IPO process, through an active disposition program, and then through a lease-up opportunity that we had in our portfolio for 2012 and 2013. We've realized all of our leasing objectives, and we've had a little bit of clarity, or a lot of clarity, I should say, on the disposition front. At the time that we set out to do the IPO, we were looking to dispose of less than 5% of our non-core assets, but shortly after the IPO, we entered into a couple of lease extensions, which gave us the optionality to sell some of the non-core assets. So we've, for the most part, exceeded our own expectations on the disposition front. So with respect to, to the IPO and the objectives of deleveraging, we're well on plan with that. And we've posted 3 solid quarters inside of this year, and for the most part, we think that the investors are really grabbing onto the opportunity that we present to them.
And you mentioned leasing, so picking up on that, you made that an emphasis as one of the goals and objectives. What progress has been made there, and what's still to be done?
Progress has been great. We've had 3 very solid quarters from a leasing perspective. This particular quarter, for instance, we grew by 90 basis points from the second quarter. We had a million square feet of leasing velocity in the third quarter, which is about a 40% improvement from the second quarter, with releasing spreads at about 6%. So very much in line, if not a little bit ahead of the peers in that regard. So leasing velocity has been very strong. We are currently sitting on a retail occupancy perspective at about 88.4% with 91.1% leased, so that 270 basis points of occupancy is yet to come online. Represents about $13.1 million in average base rent, or annual base rent, that's going to be coming online over the next, call it 12 months. $5 million of which should be coming on by the end of this year. So leasing velocity has been very strong, and it's been very compelling in terms of where we stack up against the peers. And
picking up on the disposition activity that you mentioned, what is the refining of the portfolio complete now, and what more do you have to do?
Almost. The portfolio that we had set out to dispose of at the onset of the IPO is a little different than what we're disposing. I alluded to that a little bit earlier. At the onset of the IPO, we were looking to dispose of less than 5% of non-core assets. Non-core are what we're talking about, office and industrial, that we have inside of our retail portfolio. And we now have and are projected to sell better than 50% of our disposition goals for this year, of being that non-core, that office and industrial. So a major shift in what we were doing, which basically puts us in a position for 2013 to be at our lowest level, obviously, on the non-core non-core assets. And we do believe that we're in a very good position to take advantage of 2013 and dispose of even more. Just to kind of give you the raw numbers, we had about 10 million square feet of non-core, and at the onset of 2013, if we do successfully sell off everything that we plan to sell off, we'll be at just about 2 million square feet. So really good progression on the disposition front of the non-core, which puts us in a very good position on a retail, multi-tenant retail basis going into 2013.
And does that just kind of make the company stronger as a whole with that refined focus?
Absolutely. The refined focus gives us, better clarity on who we are, better clarity on which direction we're going in terms of the multi-tenant front, and where we can kind of repackage the portfolio a little bit where we might see fit. But most importantly, take advantage of growth in the portfolio, because a lot of what we're selling is longer-term leases with very little growth. It gives us better opportunity for growth as we go into 2013 and beyond.
Steve, thank you so much for joining us.
Thanks for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.